The market is not crashing. Whoever is telling you the market is crashing, just tell them to shut the hell up, because that's what I'm about to tell you. Absolutely listen to this carefully if you don't want to have any more fear and anxiety that people are causing. A lot of people are going on about how the market is crashing. It is absolutely not crashing. No, it's not crashing. Let me tell you what exactly is going on at the moment. What's happening, what we're seeing is, at the moment, that prices are dropping across. The recent article, one of my mates were talking to me about it, and he said, oh, Bitcoin is dropping, oh, the house prices in New Zealand are crashing, and this is where the crash begins, blah, 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 blah. I see so many people just talk about it. So many people just go, oh, the housing market in New Zealand is dropping by 10%, or when I checked actually this morning, it was down from 10% to 11.2%. Bitcoin recently dropped its value as well from when it peaked at $135,000 a while back. I think it was even $145,000. When I recently saw at its peak, it was close to the gold value, which stands at $133,000 per kilo. And Bitcoin, whereas, was $135,000 AUD recently. So, and now when you look at Bitcoin, it's dropped a fair bit. It's now close to, I think, maybe $112,000 or $112,000 or something like that. I'm not too sure exactly because I checked about a week ago, but recently people were scared the Bitcoin dipped, or the housing market in New Zealand has crashed, and now that crash is coming for Australia, blah, 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 blah. No, period, it's not crashing. What's happening is something known as correction. What is a correction? Let me tell you. So corrections happen in times where the market drops from its recent peak down below to roughly 10 to 20%. That's what's known as a correction. So from where it peaked, the market, when it peaked, and now when it drops down from 10 to 20%, that's what is called a correction. And corrections usually last for a couple of weeks, or they can last for a few months. We don't know exactly how long does it last for. Sometimes it goes for 6 months to 8 months, but this is something known as correction, which actually Tony Robinson's one of the famous investors in the world and motivational speaker, speaks about it a lot in one of his books. It's called The Unshakable. He talks about correction. They happen every year. There's apparently a correction in the stock market, and we are now seeing it in the housing market. Now we're seeing it in the Bitcoin. What happens is when the market expands beyond where it should be because of something known as the quantitative easing, which we will learn about in this video moving forward, is what happens really in correction is that when the market is inflated, when it's at the top of its cap, when people, obviously now you hear about it in Australia, people are struggling to buy property, people are struggling to buy all these different kind of assets. That is because it has inflated a lot. It has inflated to a new limit, and now it's correcting itself. It's dropping from whatever the price of the property is. It will drop a bit, 10 to 20%, but then again it will blow up again. It's not like it's dropped, so it's always going to be like that. It will go back to where its normal peak was, but for the time being, for a few months, it will show some correction characteristics, which will drop, like I said, for 10 to 20%. Now, these corrections can happen for various reasons, for geopolitical events, because of inflation, or because of some quantitative easing reasons, like I said previously. So it can happen for multiple reasons, or sometimes it just happens like for whatever reason it happens. That's what it's called. When the market drops from its recent peak by 10 to 20%, it's known as correction. So that's exactly what's happened at the moment. The markets have, in New Zealand, the market's crashed by 11.2% is what I saw this morning, and that's where it's staying. While I make this video, by the time I publish it, if it drops another from 11.2% to another, say 15%, 17%, that still counts as a correction from its actual recent hike of prices. So don't worry about it. This is what happens. What people say, oh yeah, the crash is coming, or we're gonna crash, the market's gonna crash, Bitcoin going to shit, blah, blah, blah. And then what happens in the midst of this is that people around you will cause all this fear and anxiety, and you will start selling your property because you'll be like, oh yeah, I'm gonna save myself a few $100,000 by just selling now and then avoid the crash and then maybe buy later. No, what's gonna happen is during this correction, there's gonna be some investor who's gonna sit out there and he already knows about this correction. So he's really gonna be looking for an opportunity from an idiot like you to be like, yep, when someone drops the house in the market, I'm just going to snatch it up during correction. There historically has been so many investors who have been successful during a correction. Google's stocks recently, when the AIs was first launched, when ChatGPT came out by OpenAI, Google's stock got corrected because everyone thought that, oh shit, OpenAI is the new thing. Google still hasn't able to drop anything related to AI. They were a bit behind, the stock corrected, and there were a few very famous investors like Bill Ackman who jumped ahead and actually snatched up those stocks from Google at a very cheap price, and then it boosted again and he became a billionaire. Anyways, back to this story is, yes, so the price is corrected. Now, let me tell you why sometimes the price corrects and exactly what happens. So the pricing, like I said, has dropped by 10 to 20% recently. We could see further price drops. I'm not saying it never drops. It does drop at time to time. Like, you know, sometimes you may see there's a crash in the market. It does happen, and the market going from a bull run becomes a bearish market. You see prices drop significantly from a 20% drop down to 40% sometimes as well. It's happened in the past. We have seen bear markets in 2008 all the way in America. But let me tell you why exactly bear markets only sustain for a few months to a year now, and the markets always hike up back again. It's because of something known as, drum rolls please, quantitative easing. Yes, I'm not sure if a lot of the people out there, I don't think they have heard of this term, but let me explain to you what exactly quantitative easing means. QE is a monetary policy established by the government. What exactly happens during this phase of QE when the market is hit by a QE is the government will start liquidating the market by the means of either lowering the interest rates, which is the most common one, or by sort of selling the treasury bonds to you people out there. People who don't know treasury bonds, don't worry about it too much, but there are a few measures by which the government liquidates the market. The central banks, they will start pumping more money, they will start printing more money, and they will start liquidating the market. So like I just said, interest rates will see a drop, which i.e. you can borrow more money, i.e. you can spend more money, i.e. there is going to be more money in the market, which means there's going to be more liquidity into market. The government will start printing more money, which automatically means there is more money in the market now. Or, like I said, they will sell their treasury bonds, the government bonds, and that to the normal public, and through the bonds always hold a value. The bonds are something different. I'll explain different. They'll always hold their government bonds, so they're guaranteed. The government is the guarantor essentially, so you will always get your money back. So people who are investors, they will wait till when the government releases the bonds, the central banks release the bonds, and then there will be some people who actually snatch them up. But essentially, mainly they focus on either reducing the interest rates. The most recent example, well, let me take you through two examples. It happened once during the 2008 market crash, and then it happened again during COVID 2020. If anyone remembers vividly, 2020, everyone said everybody in the Australian real estate industry who aren't actually aware of this term, said that the markets are going to crash. So many people were so worried about it. Their house prices are going to go through the ground, and everything is going to go down to shit, and i.e. meaning the market is going to crash. But what happened was the government actually reduced the interest rates, started printing more money, or even in some instances released some of the bonds, which essentially meant the market got liquidated. There was a bunch of money in the market, and then from there people started spending more money, and no one realistically lost their job, so they had more money in, and you couldn't go out overseas, travel, or do anything. So what people were doing were buying new cars, investing into real estate market, which is why you saw the money that was printed out or was in the market was because the market was liquidated, actually went into the real estate, or where smart people invested into real estate, or they invested into buying gold or bitcoins or whatever they did. They invested into buying assets. That's what happens when you see heaps of liquidity in the market. People will start buying assets, so the money travels into those assets. That's how the assets value goes up through the roof. And the real estate market went from an $8 trillion industry to an $11.1 trillion as it stands at the moment, and it is going to stay like that. It's not going to be dropping. It's just a mere correction, like I said, from 10 to 20% drop. You just expect that it could drop to 20% as well. But that's the worst case scenario in a correction. If it drops any further, you will see very quickly, extremely quickly, the RBA is going to start dropping the interest rates. They're going to liquidate the market, and that's what is referred to as, once again, called quantitative easing. Quantitative easing. I can't repeat this enough. Just understand this concept. It is extremely important. It's something that has been around since 2008 specifically. Governments have always just liquidated the markets as soon as they see or they predict the market crash is coming. They will liquidate the market, and the money moves into the assets from the smart people, or the people who actually just use their money and go travel or do whatever they want to do with it. They're the ones who actually are the biggest losers, because with quantitative easing, you also see, because of printing excessive money, there's a term also known as the debasement. Another drum roll for this, please. Debasement. Debasement is another very crucial terminology, something very important to understand. Debasement is essentially when the government prints too much money, i.e. liquidate the market. What it happens is that essentially that money loses value, because now you have so much money in the market, inflation is through the roof. So that's when debasement happens. The money loses the value. Right now, no matter how much you're earning, how much wages we're earning, including myself, we can't actually even go out and buy ourselves a house if we want to. That's why I'm doing content. So that's what happens. Debasement happens when people don't have enough money to match their current market asset class. So that means that when you're trying to buy assets, you can't, because your money doesn't compare to what asset values are at the moment out there. So no matter how much you earn, well, it doesn't matter to an extent how much you earn. If you earn $1 million, good on you. You can actually go buy whatever you want. But for the majority of the people who are in the sort of lower bracket or a medium bracket of earning, they can't really go buy a house because it costs a lot more money. Because what's happened over the years is the government has just kept on printing money, and the money has lost its value. On a year, we lose 11% of value on our money. So no matter what you do with your money, just don't put it in a bank. Just go out and invest it. That's how so many people are talking about investing and blah, blah, blah. But they don't tell you why exactly you should invest. You should invest because of these two terms, quantitative easing, which means that your money actually doesn't hold any value over even next year, because of quantitative easing, government keeps liquidating the market by increasing the interest rates, by printing more money, and that means that your market is liquidated, which means that the market can never crash. Even if it does crash, it will crash for a small period of time. It will be revived soon after by the government. This trend has become more and more popular by the government because they don't want to see the 2008 crash again. There is just so much debt in the market at the moment. As we know from the USA, they own so much money to China. China owns money as well, and China has a different debt bubble issue as well. So essentially, why the government doesn't want to see another market crash is because there's already so much debt to repay, because that debt hasn't been repaid, and the debt is never going to be repaid. This is probably something for another video that we will discuss, but for this video, you definitely please just get through your head. Quantitative easing means that when you will see that the market keeps liquidating, and perhaps that's exactly why the markets will never crash. Your house value is going to stay fine. Just don't worry about it. Do not sell. If you do sell, then you're a proclaimed idiot, and someone else who's smarter than you is going to go out and actually buy that asset, and is going to soon enough, if not in a few months time, in a year, make that probably the same amount of money or make more money than what you actually expected it to do. So the markets are definitely not going to crash. Don't worry about it. It's there to stay. The real estate market is going to stay as it is. It's definitely not going to crash. So don't worry about it. To touch a little bit more on debasement, so we'll talk a little bit more about it, because what I'll tell you is that debasement essentially comes from it's an older term, debasement. It's been around for years and years. For as far as our history goes, the olden empires, they used to make gold coins, and obviously they used to make gold coins so they can trade at the time by, I'll give you one gold coin, you give me 2 packets of lentils, or you give me 2 packets of walnuts or almonds or whatever the hell you want to buy. So essentially that's what it meant at the time. You get gold coins. That's what the kings would make at the time, who was the proclaimed government at the time. They would make these gold coins, and soon enough, obviously, because the kings would go out fighting to proclaim more and more territory under them, to obviously expand the empire, exactly what we see in our geopolitical system at the moment. People going out like China, they're doing their best to proclaim the South China Sea. But anyways, let's get back to it. So what would happen is that the governments, they would go out, the kingdoms, they would go out for wars, and during wars, what they need is to have more cash so they can buy more, just more swords, I guess, or the equipment or whatever they used to use at the time, and buy more people or who will fight for them, and buy food for them. So what happened was they only had a certain amount of gold at the time. So they started mixing the gold with copper and silver and other sort of metals. So the value of that coin, going from a pure gold coin, it decreased down to, because it was mixed by various different components. So that's how debasement came in place. So the value of that gold coin decreased. It went down in value. And now, fast forward to today, what our banks are doing is exactly the same. The RBA will keep printing more money, and because of that, during COVID, or they will liquidate the market by printing more money, and the value of that money will reduce. Like I mentioned before, they have to liquidate the market so they can stop a market crash from happening, because if the markets crash, everything is going to essentially go down to shit. So they know the banks will collapse, the whole system will collapse. So the governments do not want another market crash. So that's why they will start liquidating the market. When they liquidate the market is exactly when they start printing more money or start lowering the interest rates, and it doesn't always work. There's always an economic lag, so the government will then start printing money, and because of that, the value of your dollar, what it used to buy 10 years ago, the soft serve that you used to buy for 40 cents, I remember when I was in college or in high school, when I was in year 8, year 9, a soft serve used to cost 40 cents back in 2011. And now, almost 13, 14 years later, we're seeing that same soft serve probably costs $1.10, $1.20. I'm not sure. I haven't recently gone to get a soft serve, but you know what I mean. Like, your buying power has decreased. So that's what debasement essentially means in short. So please guys, don't panic. This is just a correction. do not sell your assets, because if you do, then you're going to be a proclaimed idiot, like I said. So to stay tuned, just subscribe and keep watching my videos, and I'll hopefully try to understand the market a bit more by reading through Tony Robinson's book and all those other, listening to other, you know, corporate experts' insights, and bring to you guys in layman terms what exactly is happening. And in layman terms, what I explained is the two terms that you really need to understand today is the quantitative easing. Again, to summarize, quantitative easing means that when the government starts printing more money, lowering the interest rates to stop a market crash from happening, i.e. meaning liquidate the market with money, is what's known as quantitative easing. What that affects is the value of your currency goes down, which is known as debasement. So your buying power goes down. That's exactly how the buying power goes down. So please just understand debasement and quantitative easing. And do not sell your assets. Hold on to it and wait what happens. So thanks again for watching, and I'll see you in the next video.